As I look around the room here, I see some new faces, new friends welcome, old friends welcome back. It's good to see you again. This is the second event in a series of 4 that has been produced by the Mercatus Center at George Mason University. For those of you who are not familiar with us already, the Mercatus Center is a research and outreach center based at George Mason University on the Arlington campus. Our focus is economics. We're not exactly all things to all people, but we are all things economics, and we'd like to be a resource to you. It is the Mercatus view that public policy is best when it's viewed through the lens of economics. And so to that end, we have produced this series of in-depth seminars, somewhat different from our traditional Capitol Hill campus programs because we're taking a little longer, we're looking a little deeper on particular issues. We've also invited the press to come in, so there may be press present. The Capitol Hill campus program, of course, we don't do that. It is strictly for folks here on the Hill and in the agencies. So today's seminar is the second in the series. The previous one was designed to give an overview of how did the fiscal ship get so far off course. The next 3 are designed to provide ideas about how to get the fiscal ship back on course. Today's looks at fundamental tax reform and how tax reform can be used as an element for growth in the economy and plays its particular role. And to that end, we have a fine panel before us today. We're going to start off with Dr. Bruce Yandle, our sage from Clemson. Dr. Yandle is a distinguished adjunct professor of economics for the Capitol Hill campus program at the Mercatus Center, and he is the chairman emeritus of the College of Business and Behavioral Sciences at Clemson University. His primary research interests include public choice, regulation, and free market environmentalism. Dr. Yandle is the author or co-author of numerous books, including his most recent Common Sense and Common Law for the Environment. And Dr. Yandle also publishes a quarterly working paper on the economic situation that we're in. He has served as a member of the chairman of the South Carolina State Board of Economic Advisors, and from 1976 to 1978, he was the senior economist on the staff of the President's Council on Wage and Price Stability. From 1982 to 84, he was the executive director of the Federal Trade Commission. And before entering a career in university teaching, Dr. Yandle was in the industrial machinery business in Georgia. He has received his PhD and MBA from Georgia State University and a bachelor's from Mercer University. Welcome, Dr. Bruce Yandle.
Thanks very much, Jim, and what a pleasure to be here in the room with you today as we talk about some of the questions and perhaps some of the principles that may be important to us as we consider tax reform. I have a special fondness for hummingbirds, and every spring and summer, Dot and I spend some time at a country home in Georgia, and we put up feeders for these beautiful creatures. And I love to watch them and their behavior. And if anyone is in the room that shares an interest in hummingbirds, you know that a hummingbird each day has to fill half its body weight with nectar. They rise hungry in the morning, apparently, or whatever time they arise, and they work somewhat feverishly all day to obtain enough nectar and nourishment to stay alive, and sometimes they are not successful. And some hummingbirds die in their sleep from a lack of nourishment. They live in a world of commons. So far as we know, hummingbirds have never been able to write a constitution. They have never been able to put up fences and walls or develop property rights and rules that have to do with life on the commons. Human beings also live on a commons, but unlike hummingbirds, human beings have been able to write institutions and rules and taxes and constraints that make it possible for us to take a weekend off sometime and go and tailgate at a football game or sleep late, or indeed take a sabbatical or a vacation and still have food in the larder, because we've learned how to manage the commons somewhat. Never completely, never perfectly. My comments have to do with the fiscal commons. The fiscal commons, you can think of it as a pasture with grass growing on it, and the grass is revenue. And the shepherds come to the fiscal commons every year with their sheep, and they feed on the grass. And there's an incentive to bring as many sheep as you can bring while you're in office and get as much grass as possible. But we know it's possible to overgraze a pasture and get it to the point where the grass doesn't get enough nourishment, doesn't grow rapidly enough, is not replenished. And when that happens, we have to back up and try to find a way to reorganize. In my comments on the fiscal commons, I'm applying the concepts of public choice. Public choice is a sub-discipline in economics and politics that applies the logic of economics to political behavior. And what is very important with respect to that application, the important thing I would suggest, is incentives. What incentives do the actors face? And if we know something about the incentives, then we can begin to predict something about behavior and outcomes. Public choice has been referred to as politics without romance. In other words, when public choice helps us, it helps us to explain the way the world is, not necessarily the way you and I would like for it to be. And so keep that in mind as we apply these concepts and talk together. In my conversation, I'll be brushing up against this question, why is tax reform necessary? Another way of putting it, why is it that we have to find another strand of barbed wire to put around the pasture so that they can recover? And then why is it so hard? Why is it so hard to get change? In this discussion that relates to what we're talking about, two authors wrote a book, James Buchanan and Richard Wagner, quite a number of years ago in 1977, and the book was titled Democracy in Deficit. Their book focused on the U.S., but it really applies to all democracies. Every country, every people who have a democracy with a constitution and a fiscal commons faces the same problem. And as they describe the problem, it's pretty easy to paraphrase it. Politicians who are our agents run for office, and when they run for office, they invariably say, send me to Washington and I'm going to do some good things for my district, for my people, for my state. I'll do my best to bring back my share, our share, of what they're doing in Washington. And I'll never raise your taxes. Those two promises, when put together into an operating plan, inevitably lead toward deficits. That is, if you really keep those promises, if each one on the commons is attempting to do the same thing, then the interaction will lead to an outcome of deficits. And here's the picture of deficits for the U.S. As we look here, going back to 1940 and coming forward to the present, you can see what the deficit picture looks like. Now, there's some interesting points along this deficit. One is that you see one period of time, 4 years during the Clinton administration, when we had a surplus. But if you start in 1970 and come forward, you would see that for all but 4 years of the last 41, we have systematically run a deficit. Not only have we systematically run a deficit, there has been a tendency for it to get larger as we go forward. And so, back up here. Here we go. So as this thing has grown, as the deficit has gotten larger and larger, we have taken action steps to try to correct it. For example, in 1985, we had legislation called Graham-Rudman-Hollings. And the idea was to set a constraint, put a fence around the commons, limit spending, and in limiting spending, if it didn't work, then funds would be impounded. Graham-Rudman-Hollings appeared to have worked for about 1 year. The goal was to eliminate the deficit by 2001. And so that didn't work so well. 2/3 of the budget was exempted. Then in 1990, another piece of legislation was passed saying, well, let's get it cleaned up in 5 years. That didn't work. In 1997, Mr. Clinton and Congress together passed a statute called the Balanced Budget Law. Again, let's clean up the deficit, and wow, that's when we got the surpluses, right at that period of time. Taxes went up, there was major welfare reform, we had a booming economy, and we got some improvements. And people were so ecstatic about what was going on that in 2001, in the economic report of the president, the economists on the staff said, they didn't put it this way in the report, but they said, we are in the promised land. There will be no more deficits in the United States. We have a major concern in as much as there will be no more 30-year bonds. We won't have to borrow anymore, and the Federal Reserve will not be able to conduct open market operations because there won't be any more debt out there. Indeed, they promised that in 10 years, this was in 2001, in 10 years, all of the debt will be paid off for the entire U.S. economy. That's something of the past. We're smarter than the folks who came before us. And so here we are, looking at this record. This is deficit as a percentage of GDP. And as we all know, in spite of these efforts to put up a fence, to do some constraints, we human beings have figured out a way to work against those constraints and continue our government habit. Now, that doesn't mean that things haven't improved or that they wouldn't have been worse had we not taken the steps that we took. We put these numbers in another form by looking at debt as a percentage of GDP. And if you'll notice there, the U.S. is creeping awfully close to Greece. It's sort of interesting, we hear a lot of negative comment about Spain, and Spain is in such wonderful shape by comparison to the U.S. But we are looking more like Greece than any of our neighbors to the left on that chart, and creeping closer daily. But there's one thing that we have in the U.S. that none of the other countries have. We have the reserve currency for the world. We are the one who can take green ink and expensive paper and print with pictures of dead presidents, and the rest of the world happily takes that money, because the dollar is used as the standard for accounting and payments in all international transactions. And so unlike Italy, and unlike Greece, and unlike Spain, we can print money, and we can keep spending, and continue our deficit. But even though we can do that, we can still hear the rattles when Standard & Poor's revises our credit ratings. We can still hear the rattles of what might be done to us if we don't change our ways. Now, the people who look at deficits and debts have some rules of thumb to recommend to us. One is that if your debt becomes as much as 85% of GDP, bad things begin to happen to you. And the reason they say that is because when the debt gets that large, the interest on the debt begins to squeeze out other kinds of spending you might wish to engage in. Well, right now, with interest as low as it is, people don't worry about that. But with interest rates recovering something to their norms, it would be a huge worry. The other rule of thumb they have is that the deficit should not be any greater than 3.5% of GDP. And ours is 10. The reason for 3.5 is, well, if your economy is growing at 3.5 or more, you can run a deficit and pay it off in the future. Our country is growing at 1.7% real GDP. Nobody sees 3.5% growth even in the distant future. And we've got a 10% deficit. And so why it is so important that somehow we get tax reform? Not only are we running deficits, we have changed in terms of the composition of spending. And this gets to the point of why it's so hard. If you look at this chart, you'll notice that something happened in 1970. These two lines crossed. What are the two lines? The blue line represents the share of the federal budget that is dedicated to defense, security, transportation, and education. Those things are called Adam Smith's duties of government. Then the rest of the budget, which has to do with transfers and so forth, are represented by the line on top, the red line. Those two lines cross pass and great distance grows between them as we come forward. And so now we're getting to the point of, why is this so hard? Every one of those dollars that represented on the red line is a transfer to some human being who's glad to get it. That's the money that came home to the district, to the state, to the people, and their programs. And as that number gets larger relative to the other, it gets more and more difficult to bring about change. Now, writing in 1810, John C. Calhoun turned out a publication called A Disquisition on Government. He was exchanging ideas with other people of his time, and Calhoun wrote an interesting piece, in a way, an interesting section that speaks to the data I just showed to you. Calhoun says it's possible in a government for one group of people to become the taxpayers and another group to become tax spenders. And if you reach a situation where there are more tax spenders than there are taxpayers, then you have a dynamic, I'm paraphrasing here, then you have a dynamic that will erode the very basis for a government. And so he turns us all into a family of taxpayers and tax spenders. In an attempt to investigate this, Jody Lipford, who is an economist at Presbyterian College, Jody Lipford and I took some data produced by the Congressional Budget Office, 27 years of data, coming to 2007, that's the most recent data, and we looked at the share of that data, or I beg your pardon, the share of expenditures that were being dedicated to various categories of the budget, such as entitlements. The budget is a share of GDP, Social Security, Medicare. And then we looked at the distribution of taxpayers by quintiles based on income. And we began to map that data, and let me show you this first mapping. Let's walk slowly through this one. We'll see a couple of others. We won't have to walk as slowly. You're looking at years along the horizontal axis. The red line represents the share of all revenues paid by taxpayers in the 40% low end of the income structure. The green line is the share of all revenues paid by taxpayers in the top 10% of income earners. And the line in the middle is the share of GDP accounted for by the federal budget. Well, John C. Calhoun might be surprised if you looked at this chart. He would say, wow, you've got a lot more taxpayers, tax spenders than taxpayers now in your country, but government hasn't grown very much. It's about 21% of real GDP. There's not much effect there. And so let's peel back the onion, as they say. Now this is entitlement spending as a share of the federal budget, and then the same distribution of tax liability. Our red line is the same one we just saw. The green line is the same one we just saw. And now we're looking at entitlement spending as a share of the budget, and now we see a systematic increase. In a way, this is the ghost of John C. Calhoun, as we see that increase. Now this is both taxes paid for employment taxes, Social Security, and income taxes. Get it? That's what we're measuring here. Now let's peel the onion back a little bit more, one more time. And what we're looking at here is health and income security spending. That's taking out Social Security and Medicare. Health and income security spending as a share of the federal budget, and the distribution of the tax liability system based on income taxes paid. Now, when you stare at this for a minute, you will see that the 40% of the taxpayers that are in the lower end of the income structure get a check. They don't pay any income taxes. Their income taxes are negative. And then you see the upper end, just as it was before, and now we've gotten an increase in this entitlement spending. Now, why do I show you this? Two reasons. First, we are demonstrating the notions of public choice, which says people respond to incentives. If it costs me nothing as a taxpayer to push for more benefits, that is, if I don't pay any taxes, you would predict I would push harder. And if people like me are in the majority in a democracy, the chances are we may be successful. Those who are in the minority, that top 10%, can experience tax increases, and they may lobby and change the tax code and find other ways to deal with their unpleasantness. But the dynamics suggest that we have an inevitability here. The second reason is this explains in a way why it's so hard to do anything about it. Because we have claims, and it is called an entitlement. Now, in addition to the graphs, we did something a little more muscular. We did some statistical modeling and included in our model some other variables, but came out with some very strong results, which says, if the price of getting benefits from government falls to zero, I will demand a lot of them, more of them. And if I get paid for my lobbying, my taxes are negative, I will demand even more. And with that, we come back, in a way. Calhoun says that all human beings throughout history have had government, and he acted as though it was almost biological in his writings. Unlike hummingbirds, we form governments. And so he says there's nothing remarkable about that. The challenge, he says, is to have a constitution. What he meant by that would be constraints on our behavior that would enable us to continue to live as a free people in a republic with a democratic form of government. Thanks for your kind attention.
Thank you, Dr. Yandle. Our next presenter is Dr. Donald Marron, currently the director of the Urban Workings Tax Policy Center. Dr. Marron previously served as a member of the President's Council of Economic Advisors, as acting director of the Congressional Budget Office, and as executive director of the Congressional Joint Economic Committee. Before his government service, Dr. Marron taught economics and finance at the University of Chicago Graduate School of Business, and he served as chief financial officer of the healthcare software startup. Dr. Marron was also a visiting professor at Georgetown Public Policy Institute. He's received his PhD in economics from the Massachusetts Institute of Technology and his undergraduate degree in mathematics from Harvard University. Welcome, Dr. Marron.
Okay, so hi everybody. Pleasure to be here today. It's nice to actually look around and see some familiar faces. Some of my students from back when I taught at Georgetown. What am I here to talk about today? So I'm here to talk about tax reform generally, and in particular I want to hit you with a theme, which is Bruce showed you some charts that showed, the amount of spending, various things, amount of tax revenues. And one of the things I want to do is challenge what is often used in our discourse about how we measure taxes and how we measure spending. And I want to put forward the claim that in practice, we actually do a lot of spending programs that are run through the tax code. So let me give you an example. And this is one of myriad of examples. This one just resonated to me when I saw it. Last year, earlier this year, when President Obama put out his budget, he had a proposal, which, as best I can tell, hasn't yet been followed up on, of this idea of wanting to provide some assistance to senior citizens. As you may know, folks on Social Security haven't gotten cost of living adjustments for a couple of years because of some nuances about how inflation is measured. Obviously concerns about the state of the economy, desire to provide stimulus, and also concern that seniors didn't get much or if any benefit from the payroll tax cut that was passed at the end of last year. So he put forward a proposal to basically do a one-time special increase of $250 per beneficiary in Social Security. Straight-up spending program, everyone would recognize it as such. That then posed an interesting kind of fairness question that sometimes comes up when you do public policy. Which is that there are some senior citizens in America who did not benefit from the payroll tax because they're retired, so some retirees, who do not receive Social Security. And there are various and sundry reasons, but basically think of them as primarily being former state workers who didn't participate in Social Security. And so there was a desire, as I understand it, inside the administration, that if you're going to provide $250 of benefit to folks on Social Security, the only fair thing to do would also be to provide $250 of benefit to this group of unusual retirees who weren't in Social Security. And so the question is, well, how would you do that? Right, so you've got a group that you want to benefit, but they're obviously not in the Social Security rolls, right? Social Security doesn't know who these people are because Social Security is not writing them checks. And so the solution they came up with was, let's use the tax code instead. Right, so we can offer a tax credit, fully refundable, of $250 to these folks. And if you go through the traditional budget scoring that we all use when we talk about the federal budget situation, the Social Security piece of this would clearly score as an increase in spending, whereas the proposed tax credit for retirees outside Social Security would clearly score as a reduction in measured revenue. And so as a result, the first one would be talked about as a spending increase, but the second one would be talked about as though it were a tax cut. And I would like to offer you the hypothesis and insight that really these things, look an awful lot alike. Right? They both involve getting a $250 benefit to a certain group of targeted people. Right? So they'll accomplish whatever distributional economic goals you want to accomplish by that. They'll have the same effect on the budget. Right? We'll have to borrow $250 per person to finance that. And that basically from a budget point of view, an economic point of view, and a distributional point of view, these things are the same. And yet the way we talk about the budget often would treat them very differently. One is a tax cut, which frankly markets much better, sounds much better than a spending increase in many circles. Okay, so that's my example. Now there are lots more. Right? For those of you who are aficionados of the stimulus bill that passed in 2009, or even if you're not, if you read through the stimulus bill back in 2009, you will see that it includes several specific measures that took existing tax credits and turned them into spending programs temporarily because of concerns that people weren't taking advantage of tax credits while their incomes were low. So that again illustrates that there's actually a really close substitutability between things we do on the spending side of the budget and things we do on the tax side. Okay. Now, geeky economists have a name for this. The geeky name for this is tax expenditures. So if you've been involved in a discussion of tax expenditures, that's what I want to talk about. I'm actually going to call them tax preferences. Right? People call them tax expenditures because they want to drive home this parallelism to spending. I want to call them tax preferences for now so we can then have a discussion later on about which are actually like spending, which not. They come in several guises. There are the deductions you can take when you fill out your income taxes, so mortgage interest deduction being the most famous. Right, so a certain activity, right, you could imagine the government subsidizing it. Right? You could imagine a spending program that says, hey, we the government are going to help you with your mortgage or help you buy a home. But we run it through the tax code. Right? So things you can deduct. So there are exclusions, right, the most famous of which is the health insurance you get from your employer. That's not subject to income tax. It's not subject to payroll tax. That's basically just a source of income to you that is excluded from what the income tax applies to. There are credits, earned income tax credits, child credit, those sorts of things that basically provide a dollar benefit to the taxpayers that you are eligible for. There are preferential rates. So think about certain types of income, capital gains, dividends. At the top end, they face a 15% tax rate instead of the 35% top rate that applies to other types of ordinary income. So there's a tax preference for income that shows up in that guise. And then there are also deferrals, right? So there's certain kinds of income that you earn where you're not subject, you don't have to pay tax on it when you get it. Instead, you pay tax later on. For individuals, you do that through tax-deferred savings accounts. And then also, any of you who've been involved in the great debate about how our corporate tax system works will know that there's also deferral at the corporate level for earnings that multinationals earn abroad. Okay, so lots of these things. If you add them all together very carefully, you discover in Treasury's most recent estimates that all of these things together add up to about $1.3 trillion. You will occasionally, those of you who are aficionados, you will occasionally encounter this number and people will tell you that it's $1.1 trillion, and I have 1.3. And why is that? It's because I read footnotes, right, which turns out distinguishes geeks like me from some other people. Treasury, when they publish this data, it's in something called the Analytic Perspectives volume of the budget, chapter 16 or 17. There's a table of all the individual income tax and corporate income tax preferences. But then if you read the footnotes, it also adds in the spending side of these programs, so the part of the tax credits that are refundable, and it adds in also the payroll tax effects of them. So my 1.3 trillion here is adding up all those things together. Now, there's a big giant caveat asterisk that goes on this big giant number, which is that it's not really fair to add all of these things together. Right? If you download the Treasury table and you take a look at it, you will notice that they go out of their way not to add the numbers together. And the reason why is that all of the myriad tax preferences, of which there are about 200, is they interact with one another. And then in addition, in estimating how large they are, they don't take account of all the behavioral responses that people would undertake if these things were removed. So I'm not claiming that you could wave your magic wand and raise $1.3 trillion a year in new revenue if you just made these things disappear. All I'm going to argue here is that they are large in the aggregate. Right? So even if you give that a couple of haircuts, you're still talking hundreds upon hundreds of billions of dollars a year that are being directed through various kinds of tax preferences. And then to put that in some sort of context, we at the moment take in tax revenue overall a little bit more than $2 trillion a year, of which a little bit more than $1 trillion is done through the income tax. And so these things are large relative to the amount of revenue we collect in the tax system. So they're an important thing to keep in mind. Now, if I were a politician, instead of using key phrases like tax expenditure and tax preference, I would have been using the word loophole a lot. Right, so at this point in a political speech on this topic, I would have used the word loophole at least 30 or 40 times, and possibly thrown in a little special interest provision. And here's the thing I want to do. There are certainly loopholes and special interest provisions hidden away in the tax code. Right, there is, for example, a very famous rifle shot tax provision that is specifically designed to favor NASCAR race venues. Right, so there is the NASCAR loophole or special interest provision, if you will. But that is not the bulk of this stuff. You do not add up loopholes and special interest provisions and get up to numbers that are north of $1 trillion. Most of the action in tax expenditures and tax preferences, what politicians often call loopholes, is in very broad-based programs that benefit millions upon millions of people. And so we should not understate how difficult it would be that if you want to reform any of these things. If you're concerned about these tax preferences, you think rolling them back ought to be part of reform, let's not kid ourselves about how easy that's going to be. Biggest one by far, as I said, is the one for health insurance. Health insurance is exempt both from income taxes and from payroll taxes. Notice that's why my number up there is bigger than the ones you may have seen. People often quote that as being around $150 billion. Right? But again, I'm a geek. I read the footnotes. And if you go in the footnotes, you find the other $100 billion. Okay, so that's very large. Mortgage interest, 401k plans, earned income tax credits, charitable. You get to deduct a lot of your state and local taxes, capital gains. Notice, by the way, that all of these top ones here that I have listed, all of them are on the individual side of the tax system. That while a lot of the chatter and talk is about tax preferences and tax breaks that favor corporations, and there are plenty, the reality is that if you're thinking about tax reform and you're thinking about the aggregate amount of money out there, there's much more action on the individual tax side. So in rough terms, there's about $900 billion on the individual side, about 200 on the corporate side, and then another 200 on the payroll and spending. So most of this action is on the individual side. You actually, in 2011, you have to get down all the way to accelerated depreciation. Basically, if you were designing a perfect income tax, you would have to decide, well, how quickly do people have to write off the investments they make in structures and equipment that they use for their profits, or use to run their business. The way the tax system works is it generally allows folks to write that off faster. And that difference, the ability to write your things off faster, is treated as being a tax preference. We have, in recent years, provided a lot of accelerated depreciation and full expensing as a stimulus measure. And so as a result, actually an awful lot of that happened in 2010. And so this number is a little bit low for being the first and only corporate thing on my list. In a more normal year, it'd be a bit higher. But again, most of the action is on the individual side. Now, I want to argue that most of these things on this list are effectively spending. Right, so I was hoping that my Social Security example from the beginning was kind of, the camel's nose under the tent. Right, that you will believe me when I say, wow, the proposed tax credit looked enormously like a spending program. And then having you gotten that far, I now want to get you on the slippery slope all the way down to confessing that the mortgage interest deduction is just a spending program run through the tax code. And the way I slice this up is to say, look, a lot of these programs in the tax code, a lot of these preferences look enormously like things we've done on the spending side. They're just structured differently. So for example, the earned income tax credit. Right? You could think of that as basically being a social safety net program. Right? It's something that provides assistance to working families, right? Rewards additional work, offsets some of their payroll tax liability and more. And it looks a lot like a social safety net program. Okay? Entitlements. Again, going back to the employer health insurance example. There's a variety of spending in the budget where we try to support people in getting health insurance, right? Medicare, Medicaid, and soon to be the subsidies and the exchanges that start up in a few years. The tax subsidy towards employer-provided health insurance is doing a similar thing. I would argue it's doing it in a very inefficient manner, but the spirit of it is you provide a tax break, more people have health insurance. And so it's basically a way of doing an entitlement program, but running it through the tax code. And then finally, there are a whole bunch of economic and social subsidies that are run through the code. The one that got the most attention back in the back in the spring, wrong time of year, back in the spring was ethanol. You may remember there was a debate over in the Senate led by Tom Coburn about the ethanol tax credit. Right, that's basically something that's targeted to encourage the production and use of domestic ethanol. There are lots and lots of programs like that. They're meant to achieve specific social or economic policy goals. In the case of ethanol, right, you could easily imagine the ethanol subsidy being run out of the Department of Energy as a spending program. Right? You could be someone who's in the business of producing ethanol that will be sold into fuel markets. You can imagine a program in which the Department of Energy writes you a check and rewards you for doing that based on how many gallons you produce. But that just, that doesn't sell. Politically, that is not an attractive way to structure subsidies like this. It sells much better to design it as a tax break, and so that's what we have. And so what I want to argue is that these things look a lot like spending programs and should be evaluated as such as we think about budget reform and as we think about tax reform. Now, the reason I've done this whole hullabaloo about how I use the phrase tax preferences rather than tax expenditures for the broad category is I don't actually believe that every single thing on the tax expenditure list should be thought of as a spending program. And then in particular, the preferential rates for capital gains and for dividends are things that strike me as vital, important tax policy issues that ought to be discussed, but that to me, they are really debates about what the right structure of a tax system is. Right. The reason we offer preferential rates for capital gains and dividends is not that there's some sort of spending desire to subsidize the production of capital gains and dividends. It's because there's a long-standing debate about what's the right way to tax capital income, particularly in a world where you already have a corporate income tax. Right? And you have to think through the implications of, well, people are going to invest in corporations and pay one layer of tax there. Perhaps it makes sense to charge them a lower rate when they then get the profits from those. Right, so we can have a whole separate discussion about the right way to tax capital income. I don't want to prejudge that here. I just want to tell you that in my opinion, that those types of provisions are really fundamental debates about how you structure your tax system. They're not spending hidden inside the tax code. And so I'm not going to put them in my spending bucket. Now, suppose you now agree with me that there's lots of spending that's actually being done through the tax code. This raises an interesting question about thinking about, well, okay, if I take that seriously, how large is the government? And I already gave you that. So just flip ahead to our little bar chart here. A colleague of mine at the Tax Policy Center, Eric Toder, and I have been trying to answer that question. And so we went back to 2007, which you can think of as being kind of the last year before the world got really strange. And so kind of, last year where the data are something like what we thought the tax and government system used to look like. And what we have in the gray bar over there is just the traditional measure of how large federal spending is. Right? As Bruce did, measured as a share of the economy. And so in rough terms, back in 2007, the federal government spent about 20 cents out of every dollar in the U.S. economy. And that was roughly within hailing distance of what has been the norm over the last 40 years. And we said, well, what if you take seriously this notion that we're actually doing a lot of spending through the tax code? Well, in that case, the government's scope, the government size is actually larger than this number would suggest. And so what we did on the right-hand side here is we added in this red piece, which we've given the long name, spending like tax preferences. I'm still in the market for a better, more marketable bumper sticker type name if anyone has one. We just added it on. We said, well, in fact, if you take seriously the idea there's spending going on through the tax code, really the size of the federal government was about 24 cents out of every dollar, right? Which is a significant difference, right? Government was much bigger in some sense than we thought because we have all of these various spending programs that are being implemented through the tax code. Now, note a couple of implications of that. It's very interesting to watch kind of people of different ideological persuasions have different reactions to this. Okay? On the one hand, I'm up here trying to sell you that the federal government is bigger than you think. Okay? So that's one talking point, because we are hiding a bunch of spending programs in the tax code, and we should be cognizant of that. But notice that the other thing I'm selling you here, right? If you believe the chart on the right, if you believe the little red sliver on top, I am also selling you that there are some things you could do to increase taxes that would make the government smaller. Right? So that if you reduced certain tax preferences, the one I think they're spending like tax preferences, that would make that red piece smaller and would make the size of government smaller. And so I don't actually think this is an argument that cuts one way or the other way in the political discourse. I think it has pieces that are attractive to people with different ideological perspectives. And again, my point is government's larger than we think. Then also an implication is that if we walk back tax preferences, we might actually be making the government smaller. Okay? So now what does this have to do with tax reform? If you grab almost any policy geek off the street, right, almost actually any of your members who are walking by if they were here, almost all of them seem to be in favor of tax reform. Everyone hates our tax code. Everyone wants to fix it. Their diagnosis of the problems differs, and their proposed solutions differ. But most, in my experience, most are in favor of this idea that one of the things we should do is broaden the tax base and bring rates down. You saw Bull Simpson do that. You saw the Bipartisan Policy Center do it in its tax proposal. We've seen many other people do it. They phrase it different ways, right? If I'm a politician, I would frame it as they want to cut back on the loopholes and then use the money for some combination of deficit reduction or bringing rates down. Okay, and so what those folks are talking about is basically going after the tax expenditures, going after the tax preferences. And I agree that's, I think, the right way to frame up the tax reform discussion in America. We can have a separate discussion about moving to a consumption tax and kind of things that are, gleam in the eye of many economists. But realistically, I think the four corners of where this debate is going to happen is within the structure of the existing income tax. How do you improve it? I think the way forward there is to look at all these tax preferences, to think about changing them. If you walk them back, you have the effect of making government smaller, and then you get the choice of, are you going to use that revenue to cut rates, or are you going to use that revenue to help reduce the deficit, which is quite scary as you look out into the future. So, key to the tax reform debate, I've run over my time here, so let me just give you one more thing. All of this ultimately, right, kind of Bruce's meta point here is that there's going to be the public choice, the politics of discussing what actually gets done. Right, the reason we have these 200 tax preferences is not by accident. Right, there's been a political process that has created that. If you want them to get smaller, if you want to reduce them, make the economy and the tax code more efficient, raise some more revenue, you're going to have to confront the politics of accomplishing that. And what this bar chart shows you are estimates that we've done in my shop of trying to track through the distributional implications of the different types of tax preferences that are out there. So I won't go through it line by line here. I'll just say that basically what we've done, the different colors here represent different groups at different points in the income distribution. Right, so red will be people at the tippy top, the top 0.1%. The dark blue are people at the lower end, the bottom 20%. The medium blue there is the middle 60%, and then the kind of whitish blue is roughly the top 20% minus the very top sliver. And what you see on the right here is that the different tax preferences have very different distributional implications for folks. Right, so not surprisingly, the preference for capital gains and dividends is skewed very much to high-income folks. That's why there's that large red bar there. Use my little laser, there we go. Right, large red bar there. Whereas on the other hand, refundable credits are skewed towards the bottom and sort of parts of the middle. And so as you think about going through, my recommendation is, policymakers should go through the code line by line, evaluate each individual preference, judge it. And what you're going to discover is that tax preferences are by no means created equal. They have very, very different distributional implications, and you're going to have to take that into account as we think through tax reform. And for further information, a couple links there. Please visit our website. Thanks.
Thank you, Dr. Marron. Our final speaker, the cleanup batter today, is Mercatus' own Jason Fichtner, who is a senior research fellow at Mercatus Center. Previously, he served in several positions. He was with the Social Security Administration, where he was Deputy Commissioner of Social Security. He was Chief Economist and Associate Commissioner for Retirement Policy. And prior to the Social Security Administration, some of you may know Dr. Fichtner from his time with the Joint Economic Committee. Dr. Fichtner's primary research interests and publications address issues such as Social Security, federal tax policy, federal budget policy, retirement security, and policy proposals to increase savings and investment. Dr. Fichtner received his Bachelor of Arts degree from the University of Michigan in Ann Arbor and his Master's in Public Policy from Georgetown University and his PhD in Public Administration and Policy from Virginia Tech. In fact, his dissertation research focused on the use of tax distribution tables in federal tax policy. So without any further ado, our own Jason Fichtner.
Good afternoon, everyone, and for those of you still here, thank you for sticking through with us. don't leave yet. If you're still sitting, don't leave yet. The best presentation is still to come. I appreciate you guys being here. One of the things I want to do is sort of do cleanup for Bruce and Donald, but also sort of wrap together what kind of things you need to know now looking forward when you start seeing tax reform proposals come across your desk. When you've got to give your boss some advice about what plans are good or bad, or what do they do for the economy, who do they impact, or you're sitting at a bar arguing with a friend about one tax policy proposal is better than another. So we're going to walk through some issues and principles for reform, how to look at this a little bit from an economic standpoint of public policy, and then we'll take questions and answers afterwards. So give me 15 minutes and I'll make it worth your while. So important issues to keep in mind. How do economists like us review and evaluate tax reform proposals? Generally, we start with three general overviews. One is looking at efficiency, the other is simplicity, the third one is equity or fairness, and the last one is the most subjective. But efficiency, we all kind of realize what does that mean. It basically means that regardless of the size of government we want, or regardless of the size of revenue we want to target, we want to do that in a way that has the least minimal impact on behavior and changes in the economy. As you guys know, when you tax something, you tend to get less of it. Taxes affect behavior. So whatever you decide to do, whatever your target revenue is supposed to be, you want to do it in a way that least likely affects behavior change. So that's where we sort of look at an efficiency standpoint. Simplicity is kind of straightforward. Can you actually understand the tax code? Can you comply with it? We started things like the alternative minimum tax, where no one knows whether or not they qualify or have to pay it before they fill out the ordinary income tax first. And there's 69 different lines to fill out. There's math problems. People throw up their hands. So we really want to have things that have more simplicity in them. The less deductions, the less exemptions, the less preferences we have, the more simple it is to comply with, and in some ways, the more simple it is to raise revenue. Last one, of course, is equity. And what do we mean by equity? Equity, in some ways, is the most complicated and very subjective measure we look at, but the one that sort of picks up the most attention in the media. Are millionaires paying their fair share? Are corporations paying their fair share? Is it right that X% don't pay anything at all? What do we mean by fairness? Right? So this is one of those things we go through, and what might be fair to one person may not be fair to another. So while we could agree on issues of simplicity, we may be able to agree on issues of efficiency, we're going to have very different opinions moving by equity, but we have to talk about what that means and be open and honest, and not just show one side of the coin. We've got to show both sides. So what is fairness? We look at sort of three ways. The most common ones first are horizontal equity versus vertical. Horizontal means across the board, meaning we expect people with like incomes and like circumstances to pay like amount of taxes. So if all of you here had the exact same job and the exact same income and the exact circumstances, we want you to pay the exact same taxes. If you didn't, you'd be violating horizontal equity. We take the right side of the room for a minute. Same circumstances, you all have the same job, same income. All of a sudden, this side of the room are homeowners. This side are renters. You guys get the home mortgage interest deduction, and now I'm favoring homeowners over renters. You pay less tax depending on your mortgage. So now I'm violating in some ways horizontal equity because I'm favoring people who have homes and choose to have a mortgage over those who choose to rent. Now, we may decide that's good social policy, but we're violating horizontal equity in doing so, and that has economic consequences with it. Vertical equity means we basically expect in our progressive tax system that those who make more money pay more taxes. And that can be more nominally, also more in a progressive scale as a percentage. Those who make $10,000 should pay less than % than those who are paying 20. It should slide up. This has been a recent discussion with Warren Buffett. Is he paying a lower tax rate than his secretary? A lot of questions whether that's true numbers or not. We can talk about it later in the Q&A. But Warren Buffett makes more money than his secretary, presumably. And we would expect there to adhere to vertical equity, that he would pay more both nominally and also a higher percentage of his income would go to taxes than his secretaries. If that happens, we have vertical equity. If it's not, we violated vertical equity, and that kind of goes against our notions of fairness. There's also a third one, which is starting to get talked about more, but always kind of left out, and that's generational equity. And think Social Security. What happens if we decide to solve Social Security by raising payroll taxes today and cutting benefits in the future? Who pays for it? You guys do. In fact, you pay it both. You pay it in higher taxes today and lower benefits tomorrow. You know, the people who don't pay for it, those who are current beneficiaries. So whether that's right or wrong, that's not the policy choice. The question is to be aware we're talking about generational equity, and in some ways those who pay the bill may be the ones who are bearing the burden of it, or may get a double burden of a reduced reduction in benefits down the road. So think about generational equity if you talk about this as well. Another idea of generational equity is debt, right? If we're borrowing more money today to pay for expenditures and not taxing for it, we're taking debts out that our grandparents or future generations have to pay for. So we're burdening tomorrow's children with debts for benefits they never gained from. So those are generational equities we need to consider as well. And these are sort of like a checklist. When you start seeing reform plans come by your desk, start asking these questions. How does this go against our ideas of horizontal equity? How does it measure against our ideas of vertical equity? What about generational equity? So start measuring things and asking these questions as you go through tax reform. Another important thing is point of payment versus incidence. What we mean by incidence is who actually bears the burden, who really pays the tax, where point of payment is who writes the check to the IRS. So a good example is think about a sales tax. And when you go into a store and you want to buy a Snickers bar and it's $1 and there's a 10% tax, right? Your bill is now $1.10. Who writes the check to the IRS? The store does. But who bears the burden of that tax? You do, the consumer, right? So understand when we have an actual tax on wages, for example, you fill out your 1040, you bear the burden of it, you pay it, you file the check to the IRS. But there are other things where we look at taxes and say, oh, these people will pay for it. They're writing the check, but they're not bearing the burden. Sometimes consumers are, sometimes workers are, sometimes owners of capital are paying for it. But it's very important to look at the incidence of the burden and not just point of payment. That makes a big difference in how we look at simplicity, efficiency, and equity. It's important to look at marginal rates versus effective rates. Effective rates is basically say, take all the taxes you pay, take your income, divide the two out, that's your average effective tax rate. But the margin is what do you pay on the next additional dollar? And that's where economists are sort of more concerned with looking at it, is at the margin where your behavior is influenced. Think about a high marginal 99.6% tax rate or something. You start adding in Social Security payroll taxes, state and local taxes. If you get to the point where your next dollar is taxed at 50% or more, how does that influence your behavior to go work? So what economists look at is not so what your effective tax rate is, which is important, but what is it at the margin the next dollar earned? Because that's what affects labor and investment decisions. Take someone like me. I have my day job here at Mercatus. I have a part-time job teaching. I teach at Georgetown and Johns Hopkins. That's my marginal income. I'm taxed at that above and beyond I get at Mercatus. And some if I'm taxed too much, all of a sudden it's not worth my time to teach. It's worth my time to sit in the couch and watch movies instead. At what point is that inflection point where that marginal change affects my behavior? If it gets too high, you change behavior, you lose revenue, you lose productivity, you hurt economic growth, you hurt the benefits students get from hearing me talk, they don't get the free lunch, they got to pay for it, but they lose that benefit. So if you lower rates, in some ways, you don't get the benefit of extra growth, extra productivity, and that's what we're trying to do with tax reform. What is the tax base? We talked the idea, and Donald brought this up a little bit too, of tax preferences. In some ways, think about a triangle, all right, with rates being top and the base being bottom, and the area of the triangle is the revenue you're raising. If you widen the base, you can reduce the rates and still raise the same amount of revenue. If you shrink the base by giving tax preferences for homeowners, for ethanol fuel, for fuel-efficient cars, for tackle boxes, for NASCAR, you've now lowered the base of the triangle. You have to then supposedly raise the rates of the top part of the triangle to get the same amount of revenue. That's on a static basis. Donald mentioned tax preferences, you have to be careful adding them all up because there are interaction effects and distortionary effects. When you start minimizing the base and giving preferences, you change decision making. Also, when people start doing things for tax purposes, not because it's the best economic or productive decision. So in some ways, we could lower the rates by broadening the base and probably have a more dynamic effect that would grow the economy and hopefully even raise more revenue than we would offset. So that's important to keep in mind as well. Social policy, I'm not going to hit it too much because Donald did about tax expenditures or tax preferences. I would focus on tax expenditures in my definition, which is those things we really would call government spending being done to the tax code. Not just things like capital gains reduction, which are offset double taxation of income, but those that really could be written by the check by government agencies, the home mortgage reduction, healthcare expenditures. Those things focus on, and focus on what those mean for equity, vertical, horizontal, generational, and how that means that for fundamental reform, we're trying to look at how to make the system more efficient and fair going forward. Kind of an obvious thing, but taxes do distort behavior. This is an important point to keep along. I generally have a rule of thumb. If you tax something, you get less of it. If you want to tax investment, you'll get less of it. If you want to tax labor, you'll get less of it. If you want more of it, reduce the taxes. Now again, we still have to raise revenue for the government to do our social spending and whatever the government wants to do, like for military expenditures. But again, think about what it is at the margin. If you want more of something, tax less of it. If you want more jobs, jobs is the big thing up here. Jobs, jobs, jobs. If you want more jobs, make the cost less to employ somebody. Not just for a day, not just for a week, not for a year, but for a permanent long-term basis. This is important as well. The last thing before I run some charts, only people pay taxes. This goes back to the idea a little bit between incidence and point of payment, but think about this about when we talk to the idea of, are there corporations paying their fair share? A corporation is a legal entity, it's not a person. A corporation can't bear the burden of a tax. There's no one there. If a corporation doesn't pay, can you throw them in jail? Did Arthur Anderson go to jail? No. Think about what happens if you raise the cost of a General Motors car. Say the government decides they want some of their bailout money back. They're not getting a return on their stock investment. They put a $500 tax on every GM car made. Right? Thinking, hey, these greedy corporations who want money back and make GM pay. What happens if I put a $500 tax on a GM car? Who pays it? Anybody? Consumers are one, right? Like GM would say, there's nothing here, I shouldn't make money, so I'm going to pass on that $500 to consumers. So economists say that the incidence of a tax falls in one of three ways, or a combination of one of three. One is on consumers in the form of higher prices. It's directly put upon the consumer. The second is some say, no, the corporation will lower their price. So if the car was $10,000, instead of it going to $9,500, maybe they'll split the difference. But if the corporation splits it, who ends up paying it? So it's consumer one end. This corporation still doesn't bear the burden. They pass that along either to a reduction in the returns to capital. So those who are share owners, all of a sudden see their stock price go up less or not at all. The dividend payment they were getting is now reduced. So there's less profit for the corporation, which means the shareholders actually bear the burden. The last way through is through labor. GM may say, you know what, we can't afford the next UAW contract increase, so we're not going to give you a wage increase. We're not going to give you as much. In fact, recent studies, including somebody in the Congressional Budget Office, have shown that over the long term, not the short run, but in the long run, about 70% of the corporate tax is borne by labor. So when you hear people crying for an increase in the corporate tax rate, what they really want to do is increase the tax on workers who are trying to make it by this economy. So if you're for a corporate tax increase, you're for taxing workers more. That's basically the bottom line with these kind of policies. So again, remember, if there's one thing you can take away from this whole day, is that only people pay taxes. If you keep that in mind and put a payment versus incidence, it'll go a long way to help clarifying some of these tax policy proposals. So you get to the idea of, well, let's talk about fairness again. Who's paying what? And you can kind of see the chart in front of you. This is just federal income taxes. It does not include payroll, it does not include state, it does not include local, it does not include property, it does not include sales, state tax, tax on your haircut, whatever. It's just federal income taxes. This is what you file your 1040 on. This is what is used to fund the government services that do not have a direct benefit back, like Social Security entitlements. This is what is for education departments, defense, everything else. This is what we're talking about. How about tax reform? Right now, the top 1% pays 38% of all federal income taxes that come in. The top 5 pay 58%. The top 10% pay 70%. The top 50% are now paying 97% of all federal income taxes. Right? The bottom half is paying just under 3%. Now you may say, that's great, right? The rich should pay more. That's our progressive system. I've always said that's what we look at when we think about a vertical equity. But at some point, as Bruce was saying, how much is too much where a small group is paying for the entire share of the government's expenditures, that the cost of government to those people in the majority is now free or close to zero. So what are we looking at when we break out who's actually paying this? Who do we think of as being the rich? Everyone talks about the rich who pay their fair share. Well, who are the rich? So here's where you look at this distribution broken out by AGI. And this is IRS data. I didn't manipulate it, massage it, anything else. To be in the top 1%, you have $380,000 of income, adjusted gross income on your tax return. Right? This group is getting 20% of the income, taxable income in the society. They're paying 38% of the taxes. Now you still may say that's okay. Well, let's go down to the top 10%. $113,799 is your adjusted gross income to be in the top 10% of earners. They pay 70% of the taxes, make 45, 46% of the AGI in the country. Now the important thing about this $113,000, it's a lot of money, don't get me wrong, right? It's a good living, but this data is not individuals, it's tax returns, which means it can also include married couples who are filing jointly. So think 2 federal employees, 2 teachers, who each make $60,000 a year. You combine their adjusted gross income, making $120,000, they're not the top 10%. This doesn't also account for geographic differences. $113,000 in New York City is chump change compared to $113,000 in the states of Nebraska. So who are we actually talking about when we say the rich need to pay their fair share? In some ways, it's the top 10%. This is the middle class. The benefits that Donald talked about, one of his charts shows you who's benefiting from these preferences. The middle class are benefiting from a lot of them. The homework deduction, the exclusion for IRAs and 401ks, health insurance. These are middle class preferences that reduce the taxes of middle class. You're not going to solve the deficit if you want to just raise revenue. by focusing on the top 1%. There's not enough people there. There's not enough money there. You've got to go to the middle class. The Congressional Budget Office was asked, I think, by Chairman Paul Ryan, and he said, if we just excluded spending and all we want to do is solve the deficit problem by raising taxes alone. So all we're going to do, what do we have to do? And CBO said you'd have to double the tax rates for everybody across the board. Now, they also put a note that says that doesn't mean you get the money, though, because they realize that taxes affect behavior, and if you double everyone's tax rate, people might actually work, may not invest, and they may not pay. So CBO had a nice little note saying they might not get it, but even if you did it on a static basis, you'd have to double taxes for everybody if you want to solve the deficit on taxes alone. We know that's not possible. We also know that spending is the problem going forward, so we have to control spending, but it's important to sort of know who's paying taxes and what that means for equity and the burden, and what it also means for tax reform. So how do you reform tax systems so far? Not only where a small group's paying the largest number, but we also have a large group that don't pay any federal taxes. This slide is from the Tax Policy Center, which Donald Marron is the director. And I love this slide because it puts out and says 46.4% of households, it actually is tax returns, so they use the same analysis as the IRS. 46.4% of households will pay no federal income tax for 2011. Right? Again, this is no income tax. This includes payroll taxes, but no income taxes. So when you file your tax return, people go through the deductions, itemized deductions, and they fill out the EITC. Either they have zero or a negative tax liability. Almost half of tax returns, 140 million tax returns are filed each year. Almost half have zero or negative tax liability. How do you reform taxes and make people who aren't paying anything pay anything at all and get this to the political structure? Imagine a debate where we said we're going to raise everyone's taxes by $1. $1. Everyone's going to get a $1 tax increase, nominally. You'd have advocacy groups going out saying I'm raising taxes in the poor by 1,000%. They're not paying anything, it's an infinite number you can't actually calculate. But that would be the debate. Jason's raising taxes in the poor by 1,000 billion percent. And I'd say, it's $1. It's just $1. But this is the debate we're having problems with because of the idea of our concept of fairness. We've done so much social engineering to the tax code that right now half don't pay. Now you will hear that, well, this doesn't include payroll taxes or state and local, and that's true. So Tax Policy Center gives a nice little charts for us that show what happens if we actually include those non-recurring payroll taxes. There are things like the child tax credit and the earned income tax credit, and the EITC was actually designed to offset payroll taxes. When you include the benefits of those payments and the refundability of those payments, you still have about 18% who have zero negative tax liability, even when you include the payroll taxes they pay into the system. So now you're basically at 1/5 of taxpayers, quote unquote, aren't actually federal taxpayers. Now, yes, they probably still do pay state and local, sure they're paying sales taxes, but we're talking here about how do we reform the federal tax system. We're not trying to subsidize the states, which in some ways we do with the state and local tax deduction, which is another question we should be talking about. But we're really looking at what do we mean to reform federal taxes, so it's important we just consider federal taxes, not state, local, gas taxes, or anything else. Who will neither pay income or tax preferences? This sort of pie chart shows out where it goes between the elderly, the non-elderly, because there's some questions about whether or not this is actually a break for the really poor or the old. So I wanted to include this so you have it as a reference as well. This does not mean people are lazy. It does not mean they're tax cheats. It just means we've designed a system right now that puts the majority of the burden on a very small group of people that pay for government. There's a question whether that can be considered fair as well. This gets some ideas about principles to keep in mind, and I kind of owe these to my colleague Maurice McTeague, who's sitting in the audience. College international experience, these are principles that not only sound great, but guess what? They actually work. Keep in mind, incentives matter. What are we trying to incentivize? I love the one that came out in the recent jobs bill proposal that was a $4,000 credit to hire people that were unemployed for 6 months or longer. I can imagine going into an employer's office and asking, how long have you been unemployed for? Me saying 5 months and saying, come back in a month. You're worth $4,000 more to me in a month. You're now giving an incentive not to hire people unemployed unless they've been unemployed for 6 months or longer. That's just stupid. So think about the incentives that are going to proposals, which sounds great. We want to give incentives to hire those who are unemployed. Great. Why are we giving it a 6-month cutoff? What is that doing for the incentive structure for businesses? So we need to keep incentives in mind, even when taxing things like labor, investment. If you want more savings and investment, tax it less. If you want less of it, tax it more. If you want corporations to be here in the United States, tax them less. If you want them to be overseas, keep taxing them high. Incentives do matter. People respond to incentives, so do organizations and cultures. Perceived unfairness promotes system abuse. A lot of times fairness is in the eye of the beholder, as we talked about. If it's perceived to be inequitable or unfair, people won't comply with it. Think about what's going on in Greece right now. They're trying to put a 10% tax on people who own their houses. Because in Greece, the market's so silly, people hide their money not in banks, but they hide it in housing. They buy houses as their savings vehicle. So now Greece wants to tax them a 10% tax on the value of their house and have it administered through the electrical utility department, who doesn't want to comply. They're saying it's unfair because not only is that 10% tax changing the rules of the game, but think about how we measure ability to pay. Right? There's wealth and there's income. If you get cash coming into your personal household, you have money to pay a tax. If you're sitting on a house that you can't capitalize into money, how do you pay a tax? If you've lost your job, you have no income, and also have to pay another 10% tax on the wealth that's not realized. Is that considered fair? Even I don't think that's fair. So now you've got Greece saying that's not fair, we're not even going to pay the tax. So they're having austerity measures and a bad tax system, because not only incentives matter, but the perceived fairness matters. Things can be unfair, they can be perceived to be unfair. All that affects whether your ability to collect taxes will come true. Greece is having major problems because they're not realizing what is fair, and also how people perceive that fairness is going to affect your collection. High tax rates encourage avoidance and evasion. Again, this is a good example. Avoidance, by the way, is legal. Evasion is not. Corporations can shift income called transfer pricing to lower tax jurisdictions legally. That's just avoidance. Doesn't mean they're tax cheats. It means they're just actually looking for the best way to minimize their tax obligations as a cost. That's avoidance. Evasion is you choosing not to follow the law illegally, and we should prosecute evasion to the best extent we can. But avoidance is going to happen because people and corporations respond to incentives. Bad tax systems chase investors away. We've kind of seen that with Greece. We're starting to see it here in the U.S. Good systems attract jobs and attract investors. We have a lot of examples throughout the globe right now where taxes have been changed and investors have followed. Right? And I think that's an important lesson for the U.S. as well. If we want to reform our system, it has to be a good system that actually encourages jobs here, that'll bring investors here. Lastly, last slide, I apologize, a little bit longer. Tax reform should fix the problem. Think about what we're trying to do with tax reform. What's the problem we're trying to fix? If we're trying to fix a revenue problem, we can just solve it by raising revenue. If we're trying to solve a jobs problem, then the things we're actually doing, those policies should make sure they actually encourage jobs. So keep in mind what we're trying to do, what we're trying to fix, and make sure our policies try to fix the problem. The policy position should be based on clearly articulated principles. We don't have that. I hear a lot of tax reform proposals out there that get flown around that really don't tell you why they're doing it. Why do we want to have a millionaire's tax? What is the point of that? Since we have less millionaires in the country? If so, we'll probably do a pretty good job doing it. But what is the principle? If it's vertical equity, then our millionaires really paying less on a vertical equity scale than those in the lower end? The answer is no. So what is the principle? Make sure that it's clearly articulated, and make sure the decisions we're making are clearly applied to those principles. The other thing is long-term solutions are much more preferable to short-term. Right? In the short term, you and I can look around and say, this is only going to affect my behavior or affect my wallet for the next year. The payroll tax reduction, it's a one-year thing. How does that change the long-term structural costs of employment? It doesn't. Anything we do should be based in the long term, not just a short-run fix. The best results come from fixing everything all at once. We're talking about a lot of the ideas about tweaking at the margin. Tweaking at the margin will have marginal effects. If you want fundamental changes, you need fundamental reform. You've got to do it all at once. It's easier to swallow politically. It's always harder, but I think it's easier. People can respond to it better. If we want to really do this, folks, we've got to do it all at once, not piecemeal. And the last thing is, what's the one thing I want you guys to remember when you walk out of here? Only people can pay taxes. If you do that, you're one step ahead of most people in this country. So thank you for your time. I appreciate it. And we'll take questions if you still have.
We have heard from our scholars, and now is the opportunity for you to fill the room with your brilliance. We always have good questions from the folks here on Capitol Hill, and we're looking for no less than that today. So if you have questions, Casey, where are you with the microphone? We have a gentleman right down front here. Because we are on video, we need the microphone.
I'm a highly tax attorney. Had a lot of chance to ponder our tax system. And every year I was more and more convinced that you couldn't come up with a worse system than a progressive income tax system, which is just argument. But anyway, my question is, one of the criteria that I didn't hear you mention, which I think is very important, and I want to know why, if you why we mentioned is visibility and transparency, because a lot of our tax system has been able to fool people into really not understanding how much they're paying. I'll give you a few examples. Withholding does that. People just tend to look at the take home. All the different taxes divides it up and makes people not real. If it was one tax, I think people would be very, very shocked. And then the third part of it is, I've never heard anybody say, is that the fact that we don't really tell people what part of their taxes is going to what purpose. And if we were to say, look, everybody has to pay for military and general welfare type benefits, therefore, when the rich people are paying more tax, I would argue they are paying for all this social programs, wealth transfer. I think it would be very, very interesting if we could actually earmark it that way for people to see.
So let me take the first crack at this. You are exactly right that transparency is important. In fact, I kind of lump that in some ways under simplicity, but I think it's bigger than that. And the reason I didn't put it in there was I was short on time. That's one of the things that sort of left, but you're right. One is transparency and what do we mean by the policies, but two, also who's paying and who's not. And that's clearly articulated about how the money is being spent, as you said. So one is transparency, and can I understand what I'm paying and why, and how do I calculate it? So we don't have transparency, we get complexity and confusion. Then you have compliance problems, both from the evasion standpoint of legal avoidance. You also have avoidance in the sense that people won't understand the code they're trying to comply with. So they make involuntary but honest mistakes. So more transparency reduces complexity. And I think then you're right. The question is, what are we paying for and where does it go? And people realize who's paying what. We're paying things in the idea of even tax preferences, realizing that these aren't necessarily, they are in some ways government spending. And the nuances that go into that do a lot better job for having a system which we have support for. One of our colleagues, Len Berman, who usually is on the opposite side of me when it comes to tax issues, did say something that resonated with me in one of his latest testimonies he had on the Hill. He said, regardless of whether you think taxes should be raised or decreased, or spending should be higher or lower, the government right now is not doing a good job explaining to the public how their tax dollars are used and whether they're being used efficiently. And the perception is that they're not being used wisely. And if that's the perception, then you can't do anything about raising taxes because people don't think they're going for a fair cost. So you start laying out how much is going for the military, how much is going for defense, how much is going for social welfare programs, and you're more transparent, then we can make a better educated decision about where our dollars should go, whether to increase or decrease them. So I completely agree with the transparency side.
Dr. Mayer and Dr. Yandle, do you have things to add?
Oh, sure. So just quickly, I would say, as kind of the transparency, I put in a couple of bins. I mean, the first is the political discourse about our tax system. And as Jason and others have mentioned, I think it's a challenge when you think about things like the corporate income tax that often it sounds as though that's borne by some amorphous thing, whereas in fact we know it's ultimately borne by human beings, and it would be nice if our discourse matched onto that. Now there's a hard analytic step in between. Is it shareholders? Is it workers? Is it whatever? But I think that kind of lack of transparency and visibility about who bears it unfortunately confuses discussion. There's an issue about just sort of fundamental fairness, which is, do you believe that as a civics matter, people ought to understand their tax system, be able to respond to the incentives that are in it, not have to rely on TurboTax so much, or at least understand what TurboTax is doing on their behalf. But then being a geeky economist, I'll note that there is a counter to that, which I'm not here advocating for this, I'm just observing it. And other people have advocated for it, which is that if you're worried that the tax system creates incentives for evasion and avoidance behavior, having a non-transparent system actually makes that harder for folks because they don't know what incentives they're supposed to be responding to. And so you will hear some economists, not me today, but you will hear some economists say that there's actually an upside to a certain lack of transparency in that the inefficient distortions you can get from a tax system will be smaller.
One additional thought. We generally assume rational ignorance on the part of all of us in terms of our political behavior. That is, I'm very interested in my own tax return when I'm doing my taxes, but I'm not going to spend too much time worrying about my neighbor's taxes. And picking up on Don's point, where we do things with preferences as opposed to budgeted expenditures, it makes it easier for any one of us to be even more ignorant, rational or otherwise, and therefore less likely to push to resist changes. The more we bury this stuff, the less we can know that we'd like to change.
Other questions?
All right. I've been very.
Wait just a second for your microphone.
Oh, okay. Actually, I got a lot of questions.
Well, let's do this. You can always stick around afterwards too. Does anyone have any other questions? I know you guys have to get. I know you all have to get back to work. You've been very patient with your time. We appreciate it. Does anyone else want to ask a question? If not, we'll just keep going with this gentleman and let him go until you want to leave. Well, let's share the walk a little bit, then stick around and we'll come back to you. And then the lady back there has a question too.
I know I really shouldn't be answering the question working for Mercatus, but I came to the United States 15 years ago, and I would have had a different point of view then than I do now. But I'm starting to think that it would be much better if the things that we euphemistically call entitlements were required to be fully funded by payroll taxes every year. In other words, weren't funded by borrowing. And you would adjust other income tax rates to adjust for that transfer. It would then mean that it was very transparent exactly what those things cost, who was paying for them, and whether or not you should increase or decrease the benefits under those entitlements. What do you think?
I think we should make the gentleman here in the front row of this question. I think that's an interesting point, and it's something to take advantage of for discussion, which looks at sort of things like Social Security reform. What are we doing now when we're borrowing so much? We have this concept of a trust fund, but the trust fund is actually real. In some ways, you do want to see a full accounting of a pension system. If the government had the same thing you'd ask of private sector pensions, it should be fully funded. Whether based on a pay-as-you-go type system where revenues coming in, paper benefits coming in, and that's it, and adjusted yearly, or we would allow the government, this has implications, but the government to basically work like the thrift savings plan does for federal employees, and to invest in marketable securities, whether stocks, other bonds, or foreign investments, so they actually have real assets to fund real liabilities. And so I think one of those two ways would be a better way than doing the current system we have now. And it would be more transparent and honest.
So we have a question in the back.
My question is, if we repeal the mortgage,
Is it working?
Oh, yeah, it's working. Okay. If we repeal the mortgage, tax credit in the code, what would be the effect on the housing market writ large in the United States? Because we've created this housing market, and people pay prices for homes in part based upon getting that refund in their taxes. So if you would do that or make amendments to it, there's some proposals out there to only allow the first $250,000 or $500,000 to be eligible. What would be the larger economic effect on the housing market?
Right, so house prices go down, right, unambiguously. And I mean, there may be some cold-hearted people out there. I'm of the school that this is a problem that needs to be fixed in the long run. You don't just wave your magic wand and eliminate it tomorrow. I mean, both for the economic reason you're getting after, which is this is a peculiar time to whack the housing market over the head. And also just on a fairness thing, right? So there are people who bought a house last week who built the mortgage interest deduction into their planning for how to afford it, and it would be kind of cruel to undo it for them. Now the flip side is it turns out the mortgage interest deduction gets much more credit, I think, generally than it deserves. The research suggests it doesn't do anything really to increase homeownership. Only 21% of households in the tax data actually take advantage of it. Many people with mortgages get no benefit from it because they're in a lower tax bracket and they have a high standard deduction, so it's somewhat overrated, and its benefits are kind of skewed to high-income folks. And so, my view is that it's something that if you want to go after, there's the slicing the salami approach of take off second homes, right? Cap how much you can qualify for. Then there's also just sort of, the long-run phase-out plan. Right? Think about the 10 or 15-year plan to phase it down over time, not be cruel and unusual to the housing market today. But in the long run, right, the long-run vision is that if eventually you phase it out, you end up in a better place where people aren't encouraged to buy larger houses and people aren't encouraged to go deeper in debt, and they'll buy a house that's more appropriate for them and the capital and the economy will be better allocated. So in the long run, I think reforming it, substantially reducing it, gets you to a better economic place. But as your question suggests, right, the transition to get there is a very sensitive thing.
Dr. Marron? Isn't it true that you would want that kind of transition for most of these, that you wouldn't want to just have an abrupt rupture with the current preferences? If somebody has property that they're depreciating, you wouldn't suddenly pull that away from them either, would you?
I think it's true for a lot of. I think you really want to go through case by case, and I think the housing market in particular, right? You see a lot of effects capitalized in house prices today, so you want to be very, very sensitive to the transition. Things like walking back and reducing the exclusion for health insurance. I think that's something you can probably do on a faster tempo.
I just want to add one thing because it's important too. This goes back to our principles of make sure you're doing it. It has the intended policy effects. So the idea behind the home mortgage reduction, at least the policy goal that's stated publicly, is to encourage home ownership, not to encourage home mortgage debt, not to encourage second homes, not to encourage larger homes, not to encourage cash refinances so you can buy a car and go on vacation. All these things have had the effect, and not to support construction workers, which if that was the intention, maybe that's what it solved. So you look at the idea of what can we do if we still think, and Donald's right, our current policy hasn't increased home ownership based on other countries' experience, but what if we still think that that's a good policy goal? What could we do? And one thing is instead of making a deduction, you can make it a credit. You get a 15% credit, so those at the lower end would actually get some economic benefit from buying a house, which in that sense would prop up home values for a lot of the homes that are underwater, while minimizing the deductibility of the expense of it and the benefit for those at the high end who bought $1 million houses or second homes. That could be done in transition, but we shouldn't let the transaction costs up front skew us from not looking at it at all. I think there are things we can do by turning a lot of these deductions into credits that would then benefit the low-income people and it's lower middle class, as well as propping up price supports for homes and better long-term fiscal policy as well.
We have a question over here.
Yeah, I wondered, what do you think would be the impact of raising the Social Security cap? Like, obviously, it would raise revenue. Would there be any adverse incentives? I can't imagine people would stop working because it went up.
So, one, it makes me angry. To be the honest answer, so if you look at the last two trustees' reports, you now do have it from a purely solvency, so we get trust fund accounting without the money's going. But just by eliminating the payroll tax cap does get you under a 75-year solvency. Not sustainable over 75 years. So there's been a lot of policy push to say just raise the cap, forget about cutting benefits, forget about anything else, just raise the cap and we're fine. And in some ways we've done that for Medicare. The problem again is it does increase the cost of labor and also decreases my incentive to work. So if all of a sudden I raise the cap, again, employers pay 6.25% and I pay 6.25%. You start looking more what that adds to the cost of labor in a job market where the jobs aren't growing that much, and now you increase the cost of labor, that actually has an incentive on the employer's ability and willingness to hire, as well as the employee's incentive to work harder. So we talk about the idea of marginal taxes and reteaching. All of a sudden, if I'm thinking about that 106.8 payroll cap, now as you put the Social Security payroll tax on my additional earnings, we've now raised my marginal taxes by between 6.25 and 12.3%, depending on whether anything I actually see the full burden of that tax. That reduces my incentive to work. So there would be some effects. The question is where, and would you also see some income shifting? So right now we don't tax health benefits, aren't subject to the payroll tax. Maybe what my employer says is I can't afford to give you a $10,000 raise, you're going to get taxed on it. But guess what? I can give you a nice, better, generous health care plan. Maybe we can find you a way to give you a lease car to reduce some of your costs. So I still get more compensation, but it's not being under taxes. So you see some avoidance schemes going on as well. So you need to keep those things in mind and talk about what just to raise the cap alone.
And Dr. Fichtner, I know you mentioned in your talk the buffer rule that Obama was recently proposed. And I'm curious if, it sounds like a good political soundbite, but if it's something that could actually be implemented as tax policy, because it sounds like it functions sort of as almost a second AMT. I don't know how it would actually be a productive part of the tax code. So that's my question, what your viewpoint is on that. And Professor Marron as well.
I generally think you would see a lot more avoidance, legal avoidance, if you started taxing millionaires, or again, you find some ways to get under. If you tax something, you get less of it. Now, does that mean that people at the high end are somehow going to go from making $10 million, making sure they make less than $1 million? No. But you may see some income shifting, you may see some hiding. You may see some incentives at the margin what they decide to do with their investments. So it would be like an AMT. And again, the idea in some ways, from a political standpoint, had the millionaire's tax been more pitched as a revision to the AMT, they could just say, we're going to take the AMT and index it for inflation based on what it should have been when they first started it, and now you have an AMT that's indexed negative the middle class. That would, I think, sold as better political policy, but just to go after millionaires, the question still is, are they already paying their fair share depending on the fairness? And I think it will affect some incentives as well.
Right, so I guess I'd add, right, so the AMT, as you know, has kind of a checkered history where on the one hand it has this idea of, hey, people take advantage of a lot of tax preferences, some of them who have high income seem to pay too little, so there ought to be a second tax system. There's a certain distributional fairness logic to that, but then as it's run over the decades, it's come down the income distribution and potentially hit more families, although it keeps, you and your bosses keep patching it every year or two to prevent that from expanding too much. Part of this depends on whether in kind of the whole discussion, how you feel about the corporate income tax and whether it should be part of the discussion and how it's born. If you think the corporate income tax is borne by people, including by people who invest in capital and earn capital gains and dividends, it would be very difficult as a practical matter to build that insight into your notion of how a Buffett-like rule ought to be structured, which I think is one of the reasons why so much of the discussion is just focused on income taxes and payroll taxes. And beyond that, there aren't that many millionaires who earn, who pay ridiculously low tax rates. There are some. And, my recommendation, kind of consistent with my presentation, I think kind of the first line of attack you'd want to do would be rethinking all of the various tax preferences, like design them in a better way, make them more efficient, make them more fair, make them less economically detrimental, and then see where you end up. And I think some of what you see for the millionaires would go away with that.
I wanted to chime in here and really pick up on Jason's point. Perhaps the first question is, what are you trying to accomplish? If you're trying to get more revenue, maybe you should not be focusing on tax rates and whether someone's rate is lower than someone else's rate. Maybe that's the second consideration. You can get more revenue, as we all know, in many cases, with lower rates than with higher rates. But then the fairness consideration is important and has to come in. But perhaps first we should say, what are we trying to achieve? Is it to get more total revenue, or is it to adjust something about fairness, or what?
I think we have time for just one more question. I believe this gentleman down front has one he's eager to ask.
One of the problems I'm always seeing with tax reform is all this demagoguery about progressivity and it always. My question is, why don't people try to explain more that this notion of progressivity is sort of ridiculous, and that is that it's progressive rates. If the tax were progressive in the sense that it progressed as your income increased, you could actually argue that a tax in which the rates actually decrease as you go up in income is a progressive tax. But we've got we've fooled people into thinking that there's something inherently great about this progressive tax. And the final point of that is that I wanted to know if for that reason, I think the fair tax is the best proposal because it completely gets rid of that. But my question is really whether you guys are in favor of the fair tax. Which tax? Is that the one that you would go for?
I would say with the fair tax, I'm more inclined to pick that over our current system. And one reason why is the fact of the transparency issue of progressivity. You can still do a progressive flat tax, for lack of a better term, which you could say the first $20,000 or $24,000 is exempt from taxation, and then from there it's a flat rate. Even a two-tiered flat rate, if you want a 20, 24 rate. You could do something that's much more simple, and my thing with the flat tax I do like is trying to make sure you're not taxing savings and investing twice. I think that's important, or doing some sort of corporate integration, but I think in that sense you're right about the idea. The simpler we can make it, the more transparent it's going to be, the more in some ways there'll be interest that people understand it and have better tax policy debates in terms of better tax policy. Then you also have then more public support for the system, which I think is just helpful then for our governance overall. So I'm definitely for something like that.
The fair tax does have this concept of a prebate, if you're familiar with it. And that's sort of a little bit of a progressivity in the sense, but I think that that's obviously makes it politically much more acceptable.
Yeah.
And since everybody gets rebate.
Let's let the rest of the panel jump in here.
So just two things. So first on the fair tax, the analysis I've suggested indicate that, well, so for those who don't know, the fair tax is basically a national retail sales tax. That the rates are necessary to implement it. I mean, frankly, it'd be hard to make up all the revenue that you would need if the intent was to replace the income and payroll tax. It's extremely hard to design a sales tax that would do that. But in addition, that the rates that would be required to implement it are so high that they would induce a lot of evasion and avoidance and probably would not functionally work. There's a reason that most of the rest of the developed world, when they've chosen to do consumption taxes, choose to do them as a value-added tax rather than a sales tax. And a key reason for that is how they're enforced and collected. So now, and it's interesting, a lot of, I don't know if it's true of you, a lot of fair tax people freak out when you start talking about a VAT. Right, a VAT and a retail sales tax are really, really close siblings, except a VAT works better administratively if you want to collect a large amount of revenue. I'm sympathetic to having a VAT be part of the long-run solution, although it polls much worse than the fair tax. Just going back to your original progressivity point, I would emphasize one of the things that's always important to remember in any economic discussion is that ultimately it's not about money, it's about people's happiness, or some broad, choose your favorite word, fulfillment, right? Whatever it is that people get out of life. And so a standard view among economists, which you all can reflect on whether you feel like it's true or not, is that when people have higher incomes and more wealth, the incremental happiness they get from an extra dollar goes down, and may go down dramatically. And you see this in the data, right? You see higher income people are happier on average, right, across nations and within nation, but the incremental benefit you get from additional money goes down. And so the argument for having a progressive tax system where the actual effective rates go up with your income is that what you're really taking away from people is not money, but happiness. And that as a result, basically, the folks at the high end can bear giving up more money because at the margin, it reflects less marginal happiness.
I think that's where we'll probably need to leave it for today. Thank you very much for joining us for today's installment in our series of seminars. While each of these seminars is intended to be valuable as a standalone, they are most valuable when they are viewed in order in the series, and we invite you to come back and join us again when we will be examining the effects of fundamental budget rule changes on the 6th of October. Thank you so much, and thanks again to our fine panel.